FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is February 11th, 2020. Hard to believe this month is almost half over. We've seen continuing strength in precious metals, particularly gold. It looks like 1550 has now turned into support rather than resistance. As of yesterday, price of gold was up into the high 1570s. Silver is still lagging. Silver high $17 range, fell below $18 a couple weeks ago and just hasn't had the strength to get back. And is that an indicator that the bull market, the potential bull market in mining stocks is limited? The current bull market or uptrend is going to see a correction or a reversal, probably in the short run. And what does that mean for you as an investor? And as always, I'd like to know your opinion. Please email us, kl@kerrylutz.com. And, well, our good friend from themorganreport.com is with us now, David Morgan. And David, you almost need no introduction when it comes to silver. You are the silver guru, and you've got to be thinking about where we are in the cycle now. As expected, and let me just set the stage. As expected, we're having the strong seasonality that starts right at the end of Q4, right? December 15th. That's when it started again. And here we are, we're a month and a half later, actually 2 months later, and basically the price of gold is up 20 some odd dollars. Are you concerned about this, or is it just normal base setting, or what?
Well, I agree that, we usually get a nice run in from January up. Sometimes it's 3 months, sometimes it's longer. 2016, it went from January all the way into September, which is unusual, especially through the summer months. So gold is acting quite well. As you said, Kerry, it's building a base above 1550, which is the next level, which was resistance and now has become support. So I'm very pleased with the way gold is acting. Silver, as you said, is lagging, although I really did a study on it this morning. I had my clients from my London affiliation this morning earlier. And so I really dove deep. And silver is actually looking good to me right now. Why? Because the 50 days crossed the 100-day moving average. But more importantly, it took a tremendous amount of selling to get the silver market's price back into the channel formation. So we're building this channel. I forget the numbers. It's something like 1750 to 1820, bouncing around that 70-cent level. And it's an art, not a science. You can make your own channel formation. But that's what I call an indecision pattern, which means when in doubt, stay out. It's either going to break to the upside or break to the downside. But every time it's hit the 50-day moving average, which is moving from the left to the right in an upward manner, meaning bullish, the price of the day has touched that line, moved up, touched that line, moved up, touched that line, moved up for 5 or 6 trading sessions, which doesn't make a market. But I'm very famous for saying that one day doesn't make a market, but 5 days could give a trend. It's a 5-day trend anyway. So I like the fact that it took massive selling to bring the market down into its, keeping it quiet, keeping it within the parameters. And that happened twice. Modest buying is moving it higher. It's above the 50-day moving average every day for 5 or 6 in a row, and no one's paying attention to it. So silver may surprise us all, including yours truly. Certainly, it's been disappointing ever since we got above the really 70 gold to silver ratio, or 75. I mean, we've been in the 80s up to the 90s. Some of my really longtime friends from, I'll just say, other countries and a few in the States are so bearish that they're insisting to me that silver has to hit 100-to-1 ratio that Keith Weiner talked about months ago before we will be able to see silver, make its move and narrow that ratio. I don't know. I doubt it. I think we've been in the 90s and that's enough. And I'm long-winded, but I really got excited because I haven't really dove that deep. This group that I do with London over the web in webinar format, they're pretty savvy. And so I took out the chart and did the analysis right in front of them. And after doing that for 10 minutes or so, because they do synthetics, covered call writing and selling, that type of thing. And so anyway, I would not be surprised to see silver shoot for whatever reason. Everybody always wants to know why. Well, because there was buying pressure. Why was there buying pressure? Well, if you'd have to ask everyone that bought that day, why'd you buy? Well, because I like silver. Well, because I listen to Kerry Lutz. Well, but there's lots of reasons.
Well, don't buy it for that reason. Whatever you do, find a better reason than you heard me say.
Whenever I do a public update, it's wrong. And then in my private work, I have a much better track record, but people pay me for that. So anyway.
Yeah,
well, by the way, you did mention the stocks, and last year, every stock we had on the top tier, which is big money, safe bets, up 57%, 74%, 100%, 60%, 43%, 58%, and 50%, average being 63%. And that's better than double the S&P 500. And you can write calls on most of these companies and really juice it up to maybe even higher gains on your portfolio. So there's a time and season for everything. You want to be in the right mining parameters right now. You don't want, even though the juniors are at an all-time low, and you can't be selective there. I mean, I have a few that I really, really like, but the money is made in being in the right sector. It's just like the general market.
Right.
There's a time to be in the blue chips and there's a time to be in the NASDAQ, and you have to know when. And it's really not very complicated at all. So this year is still another year to be in the blue chips. And I think we're going to have a year equal to what we had last year, which implies another 60% gain on our top tiers and every one of them going up. So I think that will take place, but time will tell. We'll see.
Well, that would be amazing. And January effect be damned, I guess. But
I trade in and out of it. I'm sorry to interrupt, but I am a big believer, like Richard Russell, that you got to do what the market shows you. And people get mad when I don't get every call perfectly right on but there's a different format between a public, discussion like this. I mean, you got to look out months. People want to know what's going to be next year. Well, I could change my mind for my paid clients, 12 times between now and the end of the year and get it right 8 out of 12. But, if they hear this show and they play it back, a year from now, it's going to, oh, God, the guy's an idiot. He said silver stayed above this 50-day moving average, and he thought it might surprise to the upside, and it went down. See, he's wrong. Well, if you focus on every time you're wrong, you're not going to be much in the human species. We're supposed to learn from our mistakes. But anyway, move on.
Yeah, you could pretty much forget it. You're not going to be right all the time, even the best of us, but you don't have to be right all the time. And in fact, you don't even have to be right half the time.
No. I want to explore that. I had a little too much coffee, but I know you're good friends. Look, if you do like a private placement situation, and let's say you're well off, you are allowed to do it by law, and you have $50,000 of total risk capital, and you do 10 private placements, and you put 5,000 into 10 of them. Okay, so 5. 9 of them could go to zero. Not that they do, because they're much better odds than that, and one could go up their normal 30, 40 times. So you put your $5,000 in, it goes up 30 times. You have 150,000 and you risk 50 and you only were right 1 out of 10 times.
That's right.
Well, this is the thing people don't understand about, certain markets and how to invest, but you have to limit your losses too. And the way you limit your losses under those conditions, which are different than doing normal investing, is you have to divide your risk capital, and you got to make a bet on about 10. You want to spread that risk out among at least 5, if not 10, because some will go to zero. Some will go up 300-400%. Some will go up 10 times. And some will go 20, 30, 40, 50, even 100 times once in a blue moon. But I mean, these spectacular gains that you see, people like Eric Sprott or whatever, get it relatively early and ride it all the way up. I mean, look at a chart of Kirkland Lake, which we were on very early. That was a 10 bagger for us.
Yes. So here is the question, David. Because the markets are so poorly underperforming, assuming you're an accredited investor, do you just go for the private placements and say the heck with the publicly traded stock and try to get a 10 bagger there? Or do you kind of hedge your bets?
Absolutely not. The only ones that will be doing that are your, Eric Sprotts and your Rick Rules. Any accredited investor outside of those, types need to be very, very, very particular and very selective. Most of these companies are going broke. They need money to keep the lights on. They will go to the market and raise money to keep the lights on. And 6 months later, they either have to raise more money or turn off the lights. So It's a wrong time for that type of investment. Now, you can be selective, and I want to not be a hypocrite. There's one that I found out about at the New Orleans Gold Show, spent a lot of time there and did the due diligence after I got home. And we liked that one. And we did talk about it to our mastermind group, but it's more of an exception rather than a rule. But no, the way to go broke in the mining sector is buy all the penny stocks.
So
that's the way to go.
Yeah. So what do you need to look at? There's so many of these stocks just go nowhere.
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Well, first of all, you need to, look at where's the safe money, and that's the big top tier. I mean, how did I pick 7 out of 7 and they all went up? Every one of them gained last year. Every single one. How did I do that? It really isn't that hard, people. And most of these names and you'll subscribe to the Morgan Report and be disappointed because most of the names are blue chips that you're already familiar with. And, I won't buy that. In fact, I just got a new subscriber, Kerry, and he wrote me and basically said, well, I see your gains on these stocks, 700, 900, 800%. They're phenomenal. Well, those are gains from, when Pan American was at $2 or whatever,
Yeah.
But it also gained 60% last year. So I explained to him, year over year, you still can make some very good gains. Is 60%, 900%? No. But what else in your portfolio in a mining stock made you 60% last year? I'll bet you none of your penny stocks did. So the point is, you got to know what season it is in the cycle, which last year was the season for top tiers. This year, I believe, is the season for top tiers. On the speculations, basically, you got to find out really 2 things. How much money is in the treasury and what's your burn rate? So you can find out when the company's theoretically going bankrupt, because you have about better odds in the crap table than you do on most of these mining shares. So you've got to be careful. And that doesn't mean you can't select. It doesn't mean, but the whole industry, and it's a pet peeve of mine, have been geared toward these ad copywriters that write phenomenal ad copy.
Yes, they do.
Get this FOMO right away. You got this fear of missing out. If you don't get this mining company that's got this secret formula in Idaho under Dr. K that has been discovered and is probably the biggest thing, it's bigger than Australia at depth and blah, 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 blah. And it's like, oh my God, I want to buy these things. And I know most of the time which ones they are. But the whole industry is kind of geared that way. And these are unsophisticated investors that want to make up for lost time and they're greedy. And there's a huge market for that. And a lot of people that even fairly sophisticated that don't know anything about mining think that they're buying a mining company when they're buying a promoter's push, a promoter's pump. That's what they're buying in a lot of cases. And it's unfortunate. I don't like it. I have a particular aversion to it because I was so frugal in my youth and I bought into that hype. And I thought I was going to, just get rich overnight kind of thing. And exploited my own weakness, learned it, made the mistake, and discovered it was my fault in most cases, and moved on. And so that's why when I started my report, I did it in a manner that I was almost guaranteed to preserve people's capital, grow it slowly. What's interesting, I'm digressing a bit, but people love Berkshire Hathaway. When I was 22, I could have bought one share of Berkshire for $2,500.
And
People don't like to buy high-priced stocks. But if you put in that one share, it's worth $363,000 right now. I'm a little older than 22, Kerry, as you know.
I know.
But that's the point about a long-term investment. And that's what most of these companies that I pick for the top tier are. These are legacy stocks you can pass on to your kids. And that's the kind of companies that you want. Look, blue chips are called blue chips for a reason. Speculations are called speculations for a reason. Cheap stocks are cheap for a reason. But the mentality is, I could buy 100,000 shares of this 4-cent stock. Well, maybe they puff out their chest at the cocktail party, but they're going to lose their money. They're much better owning that one share of Berkshire. By the way, so I said all that about Berkshire. Well, what's interesting is gold beat Berkshire from 1999 till 2019.
Correct.
Berkshire in that time frame of 20 years, we're not talking like a 2-day trade here, was up, I think it was 369%, and gold was up like 425. I forget the exact numbers. It was put out. I just did it on a video for our paid membership, but it came from my friend Nick Bearchef that runs a BMG group out of Toronto.
Sure.
And he has an exact number. I'm doing it from memory, but the idea is correct. So even gold that Buffett hates beat Berkshire over a 20-year time frame. Now, granted, Nick did pick the start of the bull market, but I think that's okay. I think it's okay to pick the start of the bull market.
Yeah, for sure. Hey, I don't have a problem with that. So when you look at that and, like Berkshire, so Berkshire basically became the market because it got so big that it's real hard for Berkshire to outperform the market. Yeah. No matter how good the component businesses are, no matter how they reinvest the dividends and buy more shares and whatever they do, because they never do a distribution or anything, really hard for them to continue on. So what about these unknowns that are out there, companies with great projects and people just don't know about them, and then all of a sudden they explode onto the scene?
Yeah, they're called asymmetric trades. They're very, very rare. I have one, or actually two, you could say two, in the model portfolio in this highly speculative category, which I say, bet a little to win a lot, or bet money you can afford to lose. But an asymmetric trade is a game changer. It's something that's so profoundly different and so needed and adapted or adopted by the marketplace that it really, truly does have a major effect. And I believe this particular company does have that ability. They've already spoken in front of the United Nations. 2 patent pendings have become patents in the last 2 months. The projected forward-looking statement, people, high risk, projection, forward-looking, beware. But it's a $20 stock 5 years out vis-a-vis the pro forma forward-looking. So don't believe anything I'm about to say, but it would be a 20-bagger from here. Stock's at about $1. So I think it will get there, but just because I think and believe doesn't mean it will. But those are the type of things that you are talking about. These are asymmetric trades. They come along very, very, very seldom. I've seen just a few in my life. An asymmetric trade for me personally and my family was cell phones. We were very, very early on, and my mom was saying, who would want to carry a phone with them? Are you crazy? That was kind of the reaction of the general public. Why would you want a phone with you? And, it was a great big sandbox, kind of a box thing. And you know what it was like, Kerry, you're not as old as me. And, just think of what a minimal investment in the cell phone industry was like back then compared to what it's worth now.
Oh, my God. Yeah. But even there, you had to pick the right company. There are a lot of companies that went out.
We were with McCaw. There was, I don't want to give you the whole story, but you're right. And that's the same thing. You got to be willing to move around. You got to say, we had, I won't say the company because they're very friendly and they're a very well-run company, but they were on the top tier. And I hardly ever take them off, but it just wasn't performing and all the rest were. So I took it off because, I'm here to provide the best service I possibly can. And that's what I strive to do.
Of course.
Just sometimes you've got to say, hey, I don't like this anymore for the following reasons. And of course, you do upset people that own it because they pick the lowest performer. And you're supposed to pick the highest performer. That's what people don't understand is you want to pick a stock that maybe looks like it's too high, but goes higher. And there's lots of reasons for that most people don't really ever think about. But once they do think about it, it makes sense.
Oh, yeah. So when you keep trying to get those asymmetrical ones, as you say, you'll catch a lot of falling knives in the process and get bloodied from it. So anyways, so check out themorganreport.com, subscribe, and you get David's expertise. Hey, questions or comments, I appreciate it if you email us. What's your opinion on silver? Where's it going? We didn't really talk that much, David, about it, about where it's potentially heading. I mean, that's all, all speculation, basically, on our part. But the odds are that when silver confirms the gold rally, we're going to really see some movement, huh?
Yeah, well, I think, I go back to the report I wrote last month on this Scott Maynard from Guggenheim, and he's basically saying silver is his number one pick. And the interviewer asked him, well, why not gold? He said, because silver is like 65% from where it was in this bull market. He didn't use the word bull market, but from where it's been, and gold is pushing toward its recent highs, and it's a much more undervalued. And you think it's it's his number one pick. And, a guy with that kind of clout picking silver is very unusual, especially being interviewed about it at Davos. It's basically on the internet. If you want to look it up, you can type in Scott Maynard Guggenheim. I'm sure you'll pop up the video.
Yeah. Yeah. So it's going to be interesting. I mean, the gold to silver ratio now is exceedingly high, in the mid to upper 80s. And generally, it doesn't stay there for long. So either gold goes down or silver goes up, but something happens. What about, and before we go, just want to touch base on the noble metals. So platinum broke 1,000, retraced. So obviously, it is probably in the midst of a bullish trend. Palladium, 2,400. Rhodium, $10,000 rhodium. Now, I guarantee you most of you listening out there don't even know what rhodium is. The only time I've ever owned rhodium is when I had a Mont Blanc fountain pen, because they use it to toughen. They coat the nib with it. Actually, some of it's mixed in there, and it toughens up the nib. You find it in catalytic converters. It's very rare, but now it's $10,000. It's 9,500 bid, 10 and a half asked. So call it $10,000. First time rhodium has ever been that high since I've been following it. What's your take on the noble metals here, David?
Well, I'm looking to do a spread trade, long platinum, short palladium, but I want to see the trend firmly intact before I do that, because, a lot of amateurs try to pick the top or the bottom. And that is definitely an amateur's game, and definitely a way to take a fortune and turn it into a small fortune. In other words, lose money.
Yeah.
So I'd be very careful. I'm looking for that. They are interchangeable. Most are brainwashed to believe that you can only use palladium in gasoline powered.
No, not true.
Catalytic converters. Not true. Ford Motor Company used platinum for years, and switched to palladium. I doubt they'll switch back, but they are interchangeable. So on the rhodium, let me just read what I wrote in the Morgan report, because it's a little bit helpful. Rhodium prices have surged along with palladium. Price discovery in rhodium works differently than for other precious metals. The quote-unquote spot price for rhodium surged to $9,985 near the end of the month. However, that price does not come from a market where regular trading produces real-time prices. The rhodium ask price is simply declared by major refiners, with Johnson Matthey being one of the firms that publish that price. Investors must, all caps bold, hear that again, investors must know the published ask prices jumped dramatically higher, but bid prices, on the other hand, have not kept up. The bid-ask spread in the thinly traded rhodium market has always been wider than other precious metals, and it's wider than ever right now. Current bids are roughly $2,000 below the published ask price. We received an email from one of our members who sold the rhodium recently. We think this is a good idea. Although the price may still go higher, selling into strength is always wise, rather than trying to obtain the highest tick in the market. Because the spread is so wide, it is an opportunity for arbitrage, which means traders could purchase bars at the bid price and sell them at a very healthy profit for anyone paying the ask price. This, of course, assumes there are enough buyers, and in most cases, these would have to be retail buyers, dummies out there, excuse me, but that's why you pay me,
Not under contract.
And in most cases, these would have to be retail buyers because the wholesale buyers work with the refiners. So
and they buy under contract.
$2,000, find somebody that all of a sudden likes rhodium because it's that, price.
I wouldn't know where to find a bar of rhodium. I don't know if I'd recognize it. If I saw it, I probably would not. Other than it doesn't really look like platinum, and it kind of doesn't look like palladium. It's a little darker, but I don't think I'd recognize it. But there is no retail market for rhodium. I don't know where you would buy it, honestly, which means in any of these noble metal markets,
right?
It means
that's right.
It's strictly professional.
I mean, I have some platinum. This isn't it. But here it is. Even platinum, which is pretty well known. I mean, most people that are familiar with precious metals know three metals. They know gold, silver, and platinum. And as you said, platinum is the noble metal. It's the densest of all three. It takes up the least volume because it is denser than the other two. I can't get it out of the case. But the point being is I've traded it over the years. And even with it being platinum, the spread isn't nearly as bad as what I just read you from the last month's report on rhodium.
Right.
But it is quite a spread. So, that's a U.S. Mint platinum 1 ounce right there. It's not a lot of really very sophisticated artwork on it. So what is that? Roughly $1,000 in the retail market. When you go to sell platinum, I mean, normally like gold, there's a spread of maybe 3%. Silver that varies more than gold. Usually it can be 5, can be 7, can be 3. It just depends. But platinum is usually in the 7, 8, 9. I mean, it's pretty healthy. So you see a platinum, price of $1,000, and you go to sell it, and you only get $928. I'm making up a number for the idea, people. I don't know what the dealer would give you today.
Sure.
And it's a healthy hit. You don't like that, but that's the world you're in when you're in the PGMs, if in the physical world. If you're trading futures, then that's a different story. Trading options, that's a different story. Trading ETFs, that's a different story. Trading a platinum stock, that's a different story. If you're trading the physical, there's a huge spread. You better be aware of it.
Okay, and these are professional markets. There are no amateur traders there. So it's virtually guaranteed that if you're playing in these markets and you don't have the information that you need and the temperament, you will get skinned. And
thank you for that.
Virtually guaranteed.
Say it. Absolutely. Most people don't belong in that market at all.
No, I wouldn't be there. I mean, I might own a couple of platinum coins, just for the hell of it. I have some Canadian pre-1965 quarters, just out of curiosity more than anything else. But I think you summed it up well, David. But I think even though it's not the same as gold and silver as far as the markets go, because they're very thinly traded, almost by appointment, and the market is the industrial market. And nonetheless, I think it's an indicator of where the entire precious metals market is heading and why you need to be invested in it. Anyway, we're going to leave it at that, but email us, kl@kerrylutz.com. Check out David's site, themorganreport.com, and subscribe. And check out our site, Financial Survival Network. You can subscribe there. David, we'll talk to you again real soon. Probably see you up at PDAC in lovely, beautiful Toronto. Probably be snowing when we land there, right?
Right.
Okay. All right. Always great to have you on, David. Thanks so much.
Thanks for having me, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.